Margulan, hello. Good evening, friends, dear colleagues. Best wishes for the new year of 2021 to all whom I have not seen and heard yet. My question is, very often those businessmen who reached a certain level start thinking about investment. Can you please tell us how to change from the businessman status into the investor status? Can it be combined? And what is the principal difference between a businessman and investor? Many people think that a businessman and investor is one and the same thing, or some closely related or similar meanings. Sorry to tell you, but these are two very different chairs, two different role models that very often contradict each other. If being an operational businessman, you become an investor, then as a rule, either it is your business that suffers or your investments. There is no miracle. Many people make a mistake that one of the typical mistakes of businessmen in my mistake collection that are made very often. When a businessman earns some capital, he gets stuck in what I call a glass ceiling. They want to become big businessmen, whereas a big business in their meaning is a business consisting of several businesses. They start investing the capital they earned into another directions, pretending this to be a modern thing called diversification. This is a complete rubbish. I'm going to tell you today what the difference is. As I have said, those are two different role models. They can be compared by their attitude towards business. A businessman has to love his business, otherwise it won't work. I do not see a businessman who wouldn't love his business. If you don't love business, you make that it most probably not a business as an art, it's a business as an artisan. Artisan business will never be a big one. Perceive your business as art and love your business. Now, if a businessman has to love his business, then an investor should never fall in love with his business. Being an investor with big experience, I can say that after analyzing my investment failures, I can say that all of them, my defeats, mistakes, losses, damages, everything took place in those businesses that I have loved, that I have been passionate about, and where I love the founders. It has always been that if I become emotionally attached to the invested business, I had problems in them. I earned very big money on those businesses that I have been absolutely indifferent about. Moreover, such investments were imposed on me by those very businesses. I haven't been planning to invest in them directly or indirectly. After that, the circumstances have taken such a turn that I invested and earned very big money in those. Furthermore, what we're going to focus on. Businessman should always focus on his business only and never spread his attention and focus, whereas an investor should diversify. Do you see what huge difference is this? A businessman is focusing when an investor is diversifying, and the other way around, he disfocuses. Thirdly, the income source. Businessman earns on the operational profit and an investor on capitalization. Next, the profit horizon. A given business is not limited in time, and an investor has a strict term when to live off his investment. Number 5. Risk-taking examples. Businessman takes his business as a boy in love. He does not see his girl's faults as a business. And an investor is like a parent who should see all the faults and advantages of his girl, so to say, or his business. Let's continue. It is the process that is important for a businessman and the result that is important for an investor. The site. Businessman's site is focused mostly on his own field, and an investor has a macro side. He sees whole economy. He actually needs to see the trends of whole economy, even if it is a worldwide one. Number 8. Who is watching what? Businessman is watching quality of his product, his goods, and an investor is only watching the financial figures. Number 9. Attitude to the dividends. A businessman does not want to pay dividends, and an investor wants to receive as many dividends as possible. Number 10. Their earnings. A businessman is earning on his love to what he does, and an investor on the other people's love to their business. State of management. A business tends to dictatorship. He wants to manage everything, put his fingers into all things, take decisions himself. Whereas the investor tends to democracy, insisting on the corporate procedures and standards, on the corporate governance. I explained you 11 main differences between an investor and a businessman. But I also see a lot of mental traps that people are caught into if they have not defined the role properly. Defining your role and your place is the key factor to taking high-quality decisions. As long as you're trying to sit on two chairs, you will never make high-quality decisions. This has to be clearly understood. Therefore, if you want to be an investor, sell your business, put your money in a bank, take a break, and have some rest. After that, write down your investment declaration. Where and how are you going to invest? How are you going to diversify? How are you going to select your business projects, and so on. Only after that you will be able to become an investor. Please tell us, how may a businessman realize that he reached the ceiling and it is time for him to sell his business and become an investor? In order to sell your business, you have to clearly understand why are you selling it. What is the reason? What is the purpose? A business should be sold only in some particular cases. Firstly, when marginality is down, competition is growing, and you see no perspective in your business. You have to sell it. Secondly, when you are in a growing market, you are dynamic, but you are aware that you have insufficient investment funds to grow fast. This is another moment like this. I had to sell my cell phone company exactly because of this. Why? Because I understood that in the future I will have to cover, with communication, all the railroads and motorways that included adding thousands and thousands of the base stations, and I understood that I have no money, so I sold the company. Briefly, you have to sell your business only when you A. already know you cannot pull it out, or B. you see no perspective in this business. Optionally, you're burned out and wish no longer to deal with an operational business. Those are three options when you have to sell it. Margulan, you have perfectly described the steps as to how to get prepared to the investor's role. What about an advice where to invest when one has sold the business? How to find your niche? Invest in the area that you have come from, because you understand much better the risks as compared to those industries new to you. Now, right after I sold my business, I have invested in two companies, MTS and Wimpelcom. Why? Because I did not grow disappointed of the field, I did not grow disappointed of the business. I sold it only because I've been short on the investment fund. I sold my company to Wimpelcom and immediately invested my money in Wimpelcom. Because the market has been growing, I knew at knickknacks what sense would it have been for me to leave the market. And what it all resulted in the end? I got rid of all the risks, but jumped into the car that has been riding on high speed, which had only advantages. Therefore, sell your business only if you have good reason to sell. At the same time, it's very important to separate the selling process and the investment thereafter. Those are two processes that cannot be done simultaneously. Margulan, I think that your situation has led down nicely in the real life when the industry that you have sold your business in and entered as an investor has been very attractive. What can one do when, for instance, any of our participants would love to leave their business, but the field of this business is stagnating and is no longer interesting for investment? How to select the other fields and how to invest into the fields unknown to you? Well, firstly, I always recommend people not to diversify once you have reached a certain level in the business. Invest your money back to where they come from. This is the most correct rule, proven by another one. Strengthen your strength. Where the money came from is where it is to be invested. But if your field is stagnating, there is a good rule of Warren Buffett that is active here. He said that if you're riding a horse for a long time and your environment is not changing, you have to get off the dead horse. After you get off your dead horse, cash yourself out, first invest your cash in the safe actives. Afterwards, take a time out and define for yourself what you want to do in your life and what your strengths are. It means you need to analyze your strong and weak sides, what is driving you, and what you are passionate about. What can you make good? In other words, what you love doing, find your ikigai. On my platform, I'm explaining the meaning of ikigai, among other things. You may visit it and check. So, you first have to answer those questions for yourself, and only then narrow your focus. Here, one can use a method or tool of via negativa, taking it from the opposite. People very often do not know well what they want and have a clear view of what they do not want. For instance, if you go to FinViz, where there is a list of economy fields, and start excluding those fields you are not willing to work in. For some, it may be a beverage industry, for some the military complex, cigarettes, weaponry, pornography, and so on, and one may start excluding those fields away until you have something like 5 or 10 of the fields of any kind. After that, you may go deeper in those and see what subfields there are, and so on and so forth. You go this way, you may also talk to your acquaintances, in other words, find areas of entry, including those efforts of cognition. After that, start learning the topic, go deeper in. Now, when you got deep enough, it is advisable to visit exhibitions in the field, then make acquaintances with the field players on the market, with the biggest producing companies in the market, go visit them, meet people working in the market segment, buy their goods for testing, and so on and so forth. This means that there are many ways of going into the depths of the field, company, product category, anything you like. But the main thing is not to dive into investing once you have left your business. Take a break first, then go into the research period, and after that you may think about it or actually combine your investment declaration. Investment declaration is the constitution of any investor. It's the set of rules you set for yourself. It's desirable to let an expert see those rules and let him ask you questions because human beings are very often tempted to their own mental psychological traps, overestimating their capabilities and are falling down on it. But what do you think if one does not immediately dive into the field, but is probing the field by means of such investment in small investments like not so big ones, in the form of syndicates, when there is an opportunity to invest together with a lead investor into new industries that you do not know nothing about and obtain certain experience, feel it for yourself if you're ready to go further, and perhaps even get some profit on those investments. Or at least gain some experience and knowledge what it is. This is more similar to the venture investment that you're also quite experienced in. What do you say about this? Another fundamental difference between an investor and a businessman that I have forgotten to mention is that the businessman is striving to earn money, whereas the investor is trying to retain it. As you may understand, earning money and attempting to retain it makes two different procedures, two different psychologies, two different types of behavior. When you're setting yourself a goal to retain the money, the most correct approach is to make a lot of small pilot projects. Therefore, what you're explaining is a very good tool when you choose investors for yourself that are suitable to you in terms of your mentality, you respect them, and in the end you start investing together with them a small amount of money. Further on, you start getting to feel the investor's philosophy and widen your positions. This is exactly the situation when you select 2 or 3 investors that you trust, that you respect, and together with them you start investing small amounts of money. It is extremely important and critical to invest your own money because you will not learn in theory. You cannot learn investment in theory as it is a strictly practical instrument. Unless you start betting your own money, start betting your own skin, you will not feel the pain of loss. You will not get to feel whether your set of rules is correct or otherwise. When you are on the market, when you invest big money, the pain of loss may be physically unbearable. I'm glad to hear that you also consider small check investments together with the lead investment in the form of syndicate is the right approach. This is exactly what we're doing. For instance, our last successful investment has been our pre-ipo investment to Udemy. It's a very interesting story when there is an opportunity to gain access to a company that is just about to enter an exchange. As much as I know, your venture fund also is investing into various companies, but mainly it's an early stage. Can you please tell us why it is so? Now look, I have set a taboo for myself on investment into the stock exchange for the coming 2 years. Why? Because the stock market is gone crazy. It has completely lost its touch with the basic values and figures. Today, it's not an economy, it's a casino. I will give you a good example. Tesla, that is producing 500,000 cars, costs more than all the other car companies altogether. At the same time, Toyota alone produces 11 million cars, which is 20 times as much as Tesla. But Tesla is worth more than all those cars. Therefore, it is a complete madness on the stock exchange. It's a casino, no economic calculation tools and reasons are working there. So I took a time out for myself for a couple of years. Next, there is also a sign of the market crash, and the markets always end in a crash, just as in the saying, the trees do not grow up to the skies. Today, the reason for that is the fact that big numbers of unprofessional players is active on the exchange. They call it investment, especially in the pre-IPO, and so on and so forth. You know, it is always very funny to invest on the growing market, but I have set a rule for myself, then if it is funny, you like it, then most probably it is going to end badly. When the stock market is on highs, it is in growth, and then there is a drop. It just reminds of a situation when jumping from a bridge you suddenly realize that all your previous problems seemed insoluble. In fact, they may be corrected. The only problem you are dealing with, you are falling from a bridge. Exchange is just alike. When the market is growing, you're going just great, and when you start falling, you realize that all the problems may be solved, but the one you are found in right now. This is why I have invested in the private equity and venture companies. I have two funds, private equity fund, quite a big one. At present, its portfolio is worth about $200 million. This portfolio I have built up, so to say, in anti-crisis way. During a crisis, it's growing. There are sectors of economy that are growing during a crisis, and as a rule, it's the basic sectors, like foodstuffs and first priority goods. The second portfolio is the venture portfolio, the fund that I have invested into the venture companies that are dealing with the pain, which are more oriented to the business-to-business segment. And as I have been myself in big companies for a long time, I know the pain of the big companies myself. I'm keeping myself afar from the exchange, closer to the reality pains. Thanks a lot, Margulan.